Good morning, traders and investors. Roger Scott here, senior strategist of Wealth Press. I was just trying to figure out if today was a Wednesday or a Thursday because I was out of town last week on holiday. My mind is completely still upside down with dates. But it is Thursday. It's May 11th. It's about 7:51 in the morning. The market's going to gear up to open up in about an hour and 39 minutes to be exact with you. Look at that. My math is working today. The Nasdaq is up about 8 points. The Dow's down about 96 points after having a pretty solid comeback yesterday, but it still looks like the tech sector is outperforming because the numbers have been better than expected. Now, yesterday we had the CPI report. The CPI report was actually fairly neutral. It came in at 5.5. They were expecting 5.5, but it was better than 5.6, and that's on the core. On the regular headline number, they were expecting 5. We got 4.9. So things are a little bit better, but again, the market was just not pricing it in outside of technology yesterday. Looking at the PPI, that's the report that's coming out today. That's coming out in about 39 minutes. And that's the PPI. First, we have the Consumer Price Index come out. That was this report. And then we have the Producers Price Index coming out, and that's today's report. Now, last time, the CPI was also fairly subdued, but the PPI was better than expected, and the market showed some promise afterwards. We'll see if that happens again. I'm always looking at the ex-food and energy number year over year. That's the number right here. You could see that right there. Let's just highlight it while we're at it. So you could see they're expecting 3.3. Prior was 3.4. It'll be really great if the number can also fall. It would show some consistency. If the number doesn't fall, if it goes to 3.5, it'll show that producers' prices are not deflating fast enough, which would be a big concern. The big danger zone right now where I'm seeing, and it's still there even though bonds are a little higher, notice bonds are near the bottom end of this range. And typically when you see the bottom end of this range, they tend to break down. If bonds break down, that's going to be higher interest rates. If that's higher interest rates, it's going to be really nasty for stocks, especially tech stocks. Now, let's talk a little bit about global economy and what we can expect. 3 major U.S. benchmark indices ended the regular session mixed as market participants digested a tamer than expected U.S. inflation report while waiting for today's PPI report. Tech-heavy Nasdaq outperformed the major benchmark, and I'll talk a little bit about that in a minute, but I wanted to show you something real quick. Here. Remember, every time this happens, we've seen it before, we've seen it on the Dow. It breaks out to a new high, and then it cools back off, and then it goes down. So be very careful over the next couple of days because we may have a cool-off in tech stocks, especially if the PPI is not all that great today. And then funds would fluctuate from putting money into tech-heavy stocks into Dow and blue-chip stocks, or maybe even small-cap stocks, which are also not doing that well, and we'll talk about that in a minute. Alphabet rose 4% after they unveiled a new gadget that details on artificial intelligence. That's going to be very helpful. Xeon Bank fell more than 2%. I really wanted to short this stock, but I didn't. Energy stocks also retreated as the price of crude oil dropped over 1% on an unexpected increase in U.S. crude stockpiles. We'll talk about energy in a minute, and I think it may be a good time to start buying energies, and I'll show you why. Core CPI, which excludes volatile food and fuel prices, and by the way, food prices were pretty inflated. They were up, I think, 7.7% for the year. Don't quote me on that number. But deflation is not happening with food prices outside of eggs and meat. In line with expectations and slightly lower than 5.6 in March. So it is moving in the right direction, possibly, potentially. We'll know in a few months unless it gets revised. Now, after the CPI report, U.S. futures priced in a 92.6% of a no rate hike. That's impressive and one of the reasons why the bond market went higher, and only a 7.4% chance of a 0.25. Now, remember these numbers because it'll be very interesting if this number starts declining and this number starts increasing. If that happens, then the bond market will come off. But again, keep your eye on the bond market. If this starts cooling off, even though the Fed is representing in its price no interest rate hikes, that means the bond market is not believing it. The long bond, 20-year plus, anything over 10 years is a long bond. And it'll cool off and it will put pressure on tech. And I'm actually anticipating that to start happening sooner than later. And I also think that the Nasdaq is not going to be breaking out much higher because I think the top is a little bit overdone. Also, look at this divergence we're seeing here. I mean, look at this. That's very much unsustainable. It can't sustain these levels, and that looks like algo traders getting a little gung-ho happy and triggering stops before taking the market down. So I would be very, very cautious with this rally, and if it continues, I'm very skeptical that it will continue. After the release of the CPI report, as I mentioned, 92%. It'll be interesting if this goes down to 70, 60, and in light of that, it'll be interesting to see how the bond market is reacting. Just a little side note. Meanwhile, Treasury Secretary Yellen Thursday urged Congress to increase the federal debt limit $31.4 trillion. We'll see if that happens. On earnings front, Disney dropped 4% in pre-market after the company's second quarter revenue came roughly in line with expectations, and net income came in short. Not a big surprise in light of what we're seeing right now. The company also predicted wider loss in its streaming service. That's something I was not anticipating. I was actually thinking their streaming service is really getting hot and heavy. Today, we're all focused on the PPI. As I mentioned, we're looking at 3.3. If the core number is better than 3.3, it'll be much, much better. And the month over month, I'm not really concerned about. That's just nasty noise. Year over year, 2.5 would be nice. 2.4 would be nice. And 3.3x food and energy would also be nice. We'll see if that happens or not. We also have initial jobless claims. It'll be interesting to see if the number's increasing above 245 because it's been around 200, 220 for a while. It started moving higher. And I want to see if that number continues moving higher or if it's going to revert back to the moving average. So far, this hasn't been a big factor at all. Gains in media consumer product stocks in Europe are leading the overall market higher. The Bank of England is widely expected to increase rates for the 12th time in a row, another 0.25 basis point, the highest since 2008. And in China is lower as their softer than expected inflation data raised more doubts over post-COVID economic recovery. And that's what I was really skeptical about several months ago, how fast they're going to recover and what it's going to take, because they've been under pressure for a long time. And it's not remember, these are not robots we're talking about. This is a real economy made with real people. They just don't go from 0 to 100 like that. It takes a little time. Nikkei closed just about the flat line today as investors digested a mixed bag of corporate results. In terms of what you'll be hearing from the market today, Albemarle rose 2%. They've got an upgrade. Twilio dropped. They got a downgrade. I think we mentioned Twilio yesterday. And you have a lot of earnings today, but most of these earnings are on smaller stocks. The big cap stocks are already behind us. Now, one of the things that you need to pay attention to is this is not really a head and shoulders, but it's a variation of a head and shoulder pattern. And right now, it looks to me like, I mean, we could be seeing something different, but it looks to me like the small caps are struggling and they're near the lows. And if this breaks down, it's not going to be good for the broad market, and it's going to deter us from the fact that there may be a recovery in store. Because small caps, as I showed you, small caps, look at this. Look at when small caps peaked out. Let me show you this. Look at that. They pretty much didn't do anything here. This was pretty much the top. This was a little happy rally when Biden got elected. But this is pretty much when they peaked out, around 321. Look at when the large caps peaked out. 122, a long time afterwards. And also, you're seeing the same type of consolidation. You're seeing the same type of consolidation within the S&P 500. So to me, it looks like we're going to huff and puff around here and then come back down because earnings are behind us, summer's coming, inflationary data is not getting fast enough, and the bond market is hovering near the lows. So to me, it looks like we're going to break down. Now, we could break up, and I could be totally wrong about this, but I don't know. It looks to me like bonds, there's just not a major catalyst. The trend has been going down quite steady, and it's not as bouncy as it was before. And even after yesterday's CPI, we rallied very little. So my question is, what's going to be the catalyst to bring interest rates lower? Now, today's sectors. Remember, today's Thursday. We talk about top ETF and option. Utilities look like they're still coming up. I like utilities right now. Now, energies look like they've had it. I think energies are near the bottom, and I think we're having a shakeout. So it may be a good time to start nibbling on the energy stocks. Consumer discretionary stocks are coming down. Now, if you look at consumer discretionary, I want to show you this chart. This is why it's really great to look at momentum levels. Now, look at this. It looks like they're breaking out, right? Looks really good here. But look how it looks internally. Where is it? I just had it here. Internally, momentum levels are coming down. They're not coming up. They're going lower. They're getting weaker, not higher. So if the number of stocks trading above the 20-day moving average is declining, and you're seeing this increasing, that means less stocks are causing the upside. And that's something that's very unsustainable. And remember, consumer discretionary is a big part of technology like Apple, Amazon, Microsoft. These are all consumer discretionary companies, right? And they're also tech companies. So if this is having an issue getting higher, and if momentum levels are declining, as I showed you a minute ago, that's not very, very positive. So just a big note about consumer discretionary. Basic materials looks like it's coming down. It may have a little more down to go. It may come up, but basic materials aren't looking all that bad. Now, let me take you through Stock Fetcher. Again, consumer discretionary is the #1 sector right now, but momentum levels are declining, not increasing. So I would much more focus on consumer staples, industrial. I don't know about real estate right now. I'd be careful with real estate and financial. These two I would be really cautious about. But I like consumer staples. I like industrial. I like healthcare. I really like utilities. I like basic materials. And I'm starting to like energies again as well. Because energies just don't look like they have that much more to go, as you will see right here. Notice what happens when momentum levels get to this level. They tend to pull back up. And if you look at the XLE sector right now, at the energy sector, look at that. It looks like doesn't have that much more to go to the downside before it starts coming back up. Now, we could have a very, very choppy period with energy sector, but I'm telling you right now, I don't think that it has that much more to go. Maybe just a hair more before it starts going up. The bottom line is I would start looking at the most relative strength, highest relative strength energy companies. And that's something I'll go through today with you in the VIP room. But you got to be really careful with consumer discretionary because this thing, it looks like it's breaking out. Look at that. It's breaking out to the upside, right? But momentum levels are declining. And we always have to take momentum levels into account. So you got to be really, really cautious. Now, folks, before I let you go, I got something important for you. I want to give you the top ETF right now that I like. The top ETF that I like right now is consumer staples. And I've been talking about that for a few weeks now. Now, I know it's been coming down a little bit, but I think it's a little overdone. And I think consumer staple stocks still have a lot more to go. I mean, look at Coca-Cola, for example. Look at General Mills. I mean, these stocks are still very, very strong. And I think they're pulling back temporarily. So definitely consumer staples, ticker symbol XLP. Right? Or if you want to nibble, I do like the energies right now. I think they're going to come up, but I would feel more comfortable putting you in XLP. The option that I would be looking at right now would probably be the one that expires about 100 days, 99 days from now. You got plenty of open interest. Go with the 80. Look at this. It's about 670 cents. I mean, that's a pretty cheap option, and it's pretty out of the money. If you want to go in the money, go with the 75. Just wait for it to open. It'll get nice and tight, or the 80, one or the other. But this thing has 99 days to go. And I think by that time, consumer staples will have another major rally. Now, before I let you go, and by the way, I know you haven't been watching or subscribing to my YouTube Wealth Press channel. Remember to go there. That's where I post these videos. That's where I want to hear and see comments. Like us, subscribe to us. And you can subscribe to my Telegram channel there as well. Now, before I let you go, only 30 stocks in the S&P are trading higher in 2023. Only 30 stocks in the S&P. The other 470 are still in the red. Can you imagine that? That's not a really bullish market, and that kind of confirms what I've been telling you. But what's really interesting is the reason those 30 stocks are trading higher. It has nothing to do with momentum or fundamentals. It's all because of news headlines and major catalysts. And if you know how to target these headlines, you could unlock the potential for some really juicy, amazing gain opportunities. And my buddy Lance Ippolito, he's about to go live at 1 p.m. today, May 11th, to reveal details of how he uses this information as a key part of his trading strategy. Click the link below, save your seat, watch Lance's free presentation. You don't want to miss out. Lance is red hot. He's a great guy. He's a great trader, and he's not gonna lead you astray. It's happening live today at 1 p.m. Check it out. 30 stocks, and why those 30 stocks are outperforming the market. It's sad, but it's true. Only 30 stocks out of 500 are higher in 2023 than 2022. That means the market is getting very narrow, and that's actually what I was telling you when I was showing you consumer discretionary. Consumer discretionary technically looks higher. Momentum levels are going lower, which means there's only a handful of stocks driving it higher, like Apple maybe, or Amazon, so forth. Follow the link below. You don't want to miss out. Lance is going to uncover all of this for you. It's happening right after my VIP room today. Actually, no, my VIP room is at 10 o'clock. His session's at 1 p.m. Eastern time, so you'll have plenty of time, and I'll remind you again about it during my VIP room. I'll see you guys later. Have a great day. Bye.